Hello, everybody. Welcome to Wednesday. The S&P 500 was down 0.16% today, just kind of continuing the little downturn that we started yesterday for the beginning of this month. We'll have to see how this works out. But today we got a report on open jobs. And so it used to be that there was too many open jobs, 11.4 million open jobs. And now the market's worried about the number of job openings dropping. It actually was lower than what it was expected to be today. So the market was bothered by that a little bit. Again, the focus has gone from inflation to recession, and jobs are going to be part of what gets really focused on because the Fed has a dual mandate of keeping inflation low and keeping what they call full employment, which is around 4% on unemployment. We're a little bit higher than that right now at 4.3%. So on Friday, going to get the jobs report for how many jobs were created last month. If that comes out weak, it just kind of, compounds the thought process of recession and those types of things. What happened last month was we got some of these type of numbers, and they were kind of weak. And then we got a bunch of really strong numbers and the market actually recovered fully. So it's kind of interesting. We're in that zone right now where, seasonally it's not that strong. And we've got, good news coming and bad news coming, both about recession, as far as that goes, showing some strength and also some weakness. And really we're walking, I think, down the middle at the moment. That could transition into, recession at some point in the future. The Fed has made lots of mistakes in the past in their history of keeping rates up too long or raising them too high and causing recessions. And that's what's really bothering the market right now. Just the history of dealing with the Fed. This particular Fed group, for the most part, didn't raise rates soon enough in hindsight. Kept saying that inflation would be transitionary. Maybe it was going to be, but it would have been over about 5 years and too long for people to deal with, obviously. So, now they're worried about, trying to get inflation all the way back down, leave rates up too long. We could have a recession. Unfortunately, with the Fed's track history, the probability is that they will mess this up. However, they've done a decent job so far with this. They've gotten maybe a little lucky. We have a lot of, government and consumer spending going on that's offsetting, the possible recession that we could be in. A lot of that's still continuing, and then the market has artificial intelligence and good earnings overall to focus on. So I think this is just going to be a soft spot. I said at the show last week that I didn't think we'd end up just kind of skyrocketing all the way through to the election. There's too much volatility that happens before an election. So I think we just need to be patient, wait. I think again, November is the time frame we should see some really good motion. So right now we're actually rotating via the algorithm that we use to look at our universe of ETFs. We are seeing a lot of different things besides technology move up to the top of that list. And we've been buying that over the last 5 weeks, and we really don't have technology anymore in our target pieces that we use. Obviously, it's in the big, overall indexes like the S&P 500 is very heavy with technology because they're just such big companies. But, it's been interesting to see what's moving up. Low volatility ETF, the Staples was bought today, financials that were bought today, real estate that's in there. So it's really interesting to see there's a big diversification going away from technology into these different sectors as far as that goes. And a matter of fact, most of those were up today, which is kind of interesting, even though the market was down overall. And real estate did really well, that type of thing. So, and of course, we're in the bond market and we're in the longer term portion of the bond market for some of our models. That did really well today too, because, when there's a fear of a recession, that means that rates are coming down, and that's good for bonds. So this could be a good market for bonds. It has been a decent one here for the last few weeks anyway. So again, Fed meets not too long from now, the 18th of September. They'll decide on, they're going to do a half-point rate cut or not, or a quarter point as far as that goes. So we'll see how that plays out. But a lot more bets on a half point today after the soft, job openings report. So see what happens. We'll talk to you tomorrow. Thank you.